What's up, YouTube? What's up, podcast? What's up, Spotify? Everybody, what's up? What's up? What's up? I'm back and I'm so happy to be back. It's been a while, but I only wanted to come back when I had something of significance to express, right? So, without further ado, this is Finance King. You're watching Assets Under Management. Let's get into it. In our new economic news, the last time we spoke about the stock market and where SPY was at, and it was about 450, 451. Well, what are we, a couple weeks later, and it's still at 451. Today we're coming in at 451.35. And so not much has changed, but there has been a peak, and then it's made a valley, and now it's back up. So what are we looking for right now? We actually want to see if this valley that it made is the low. It's going to be the swing low, and we break above the recent high. That the recent high is about 459. Give me 1 second, I can check for you. The recent high is about 459 on the dot, right? And so we want to see if we're going to push above that 459 and create newer highs, or if that 459 is going to hold a strong resistance and pushes back down, creating sort of like a head and shoulders pattern. As we had a peak over this side, the larger peak, and now we're making another smaller peak. Head and shoulders is typically a bearish pattern. So if we are making the head and shoulders, the neckline on the head and shoulder is 432, which would also serve as a major supply zone or major support zone. So if we break that 432, we could go lower, a lot lower actually. It looks like around a 415-ish, maybe. Some resistance at the 420, all the way down to about 410 is a major supply zone. So, and with that, we want to see, are we going to push above that 459, or are we going to break below that 432? We've been in this range for the last couple of weeks, so that's something to look out for. And now we're here for a good section. I love this section. Let's define the asset. So we're going to continue breaking down the 401k because I want to do a deep dive. And actually, I'm going to make the remainder of this podcast about the 401k and what it involves, and as it comes to your traditional method of retirement. When I say traditional, I mean using the 401k and what we are taught as working middle class. So let's get right into it. So we're taught that the working middle class is to work, put money into a savings account, into a 401k, a retirement account, work a long period of time, 30, 40, 50, whatever years. And then when we retire, we hope that the money that's in that account has accumulated and appreciated enough for us to last through our retirement. But up to 80% of us don't know how much money we need after we retire, which is one bad thing, right? The number one bad thing. But then even if we do 50% or 60%, or between 50 and 60% of the people that do know their number aren't confident that they can reach a number that's good enough for them in retirement, right? So why is this system being taught or projected on us so much? Well, if we break it down, I think it has something to do with the business side of the 401k and who's really profiting off of the money in a 401k, but that's a different conversation. What I want to do here is really enlighten you to how you're using your money, moving your money, and spending your money, right? So let's say, for example, we're all working middle class. You have your job, I have mine. We go to work, we deposit money into a 401k. Do you know where the money in your 401k is going? Chances are you don't. Chances are you got a thick packet of information from your company. You filled it out rather quickly. You tried to skim through it, but it all looked like jargon, a maze that you really couldn't understand. So you continue to fill it out. You knew it was 401k paperwork, retirement paperwork, and benefits paperwork, so you just signed the dotted line. Well, what is set up is actually the money that you put into the 401k is then given to a company, most likely a mutual fund company. This mutual fund company is investing your money, right? But they're also charging you to invest the money. Now, that's one thing. So let's take that. So most mutual funds charge anywhere between 1% to 3% of an annual fee, right? To invest your money and to produce returns on your money. Okay, so that's we got that. So let's be generous. Let's say they charge 1.5, right in the middle. So you got 1.5 of annual fees that's paid out to the mutual fund. Well, there's also fees paid out from the custodian that's holding the 401k, right? Because they're doing work too. So now you're paying fees to the custodian of the 401k, you're paying fees to the mutual fund. Okay, so we got the two fees added up. Let's say that adds up to 2%, 2.5%. And then there's other fees that are involved as far as trading fees, transactional fees. There's something called a spread, which means there's a number that the buyer is willing to sell at, or the buyer is willing to buy at, and a number that the seller is willing to sell at. And so the broker, which is the person that house, or the company that house your 401k, is the man in the middle. And it's the broker's job to get the price in the middle. Well, they tell you to pay 5 cents, whereas the seller is selling it. Well, they tell you to pay, 7 cents as the seller. And I'm messing up. They tell you to pay 7 cents as the buyer. And then the sellers over here is selling it at 5 cents, right? So they keep the 2 cents. Now, in real life, the spread is much smaller than that. Maybe it's, like a half a cent or a cent or whatever the case may be. But over time, all of those transactions add up. And once the mutual fund does enough throughout the course of the year, it turns into a percentage, a very small percent, but it's the percentage nonetheless of your money that's going out the window. So now we add that into the 1.5% of the mutual fund fees, the 0.5% of the brokerage account fees, and then we have maybe, let's say, another 0.25% of transactional fees and other fees that, we're not going to get into because it's a lot actually. But there are a lot of fees that maybe is not written in the literature. Maybe it is, but most likely it's not. And it just occurs because of the style of business, that's all. And so we have these fees, right? But it totals up to a lump sum of maybe anywhere between 2 to 4 total percent, right? So I want to do some math and show you just exactly what the money could do versus what it's doing with fees, right? So what a 401k basically is, it's, say you're going into business with someone, right? And this is the concept of it. You're going into business with someone. You're putting up all the money. You're taking all the risks. If the business flops, you lose your money. But if the business does well, you don't get all of the money, you just get a portion of the money, right? Is this something that you would ever jump to do? Would you really say, okay, yeah, I'm willing to go into business in this way, under these conditions? Most likely the answer is no. But the thing is, we do it every day with this 401k. And I want to show you this, right? I'm going to throw out some numbers. So just stay with me here. Let's say the 401k returns 7% annually, which is very good, right? We're going to take a modest number, 7%, but the stock market, S&P 500, returns about 9% over the last 20, 30 some years on average. So we're going to take a modest number, say 7%. So if you were to invest 10K into the 401k at 7% at the age 20, by the time you retire at 65, you'll have $575,000. $575,000 off of $10,000, which is great. This is a lovely appreciation, uh, accumulation, right? All the Asians. This is a lovely amount of money that has shown growth that you can use, right? This is what it's for. That's no fees. So let's take the same thing and then add fees on top of it. And watch this. So we're going to take just 2.5%, breaking down as giving you the example that I gave you earlier with all of the total fees. So we're going to take those 2.5%. We're going to take the same $10,000. We're going to have it for the same amount of time at age 20 until retirement. And then we're going to have the same rate of return, which is 7%. So no fees, you got $576,000. With fees, that only produces $140,000 for you in the same period, same time. Everything else is the same. And so what we see here is that you're missing about $330,000. Where did it go? It's ate up by fees. That 2.5% makes a very, very, very large difference, because when you think of this 7% annual growth and you paying fees on top of that, well, your fees is not really, or your annual growth is not really 7%. It's more like 4.5%. And so that's where the math gets tricky. So they give you these high return numbers, right? They give you these high return numbers and they make it seem like, it's very beneficial, but they don't tell you all the fees, or they may give you a low expense ratio. But the expense ratio, and this is just me knowing from studying and actually being in the industry and everything, the expense ratio doesn't account for all the actual expenses or fees that a mutual fund has to pay for, or we have to pay for, i.e. Trading fees and different things like that, right? It doesn't take into account all of that. So when they can say that they have a very, very low expense ratio, they could, but that might not be the true expense ratio. Then, secondly, there's a thing, a term called, I want to get it right, it's called time versus average, right? Time versus average. Now what this means is, again, we're saying the stock market, we don't even have to use a mutual fund. We can use the stock market. A stock market returns 7% on average, right? For the last 20 years. Okay, so if I put $100,000 into the stock market at January 1st, I should expect $7,000, well, $107,000 at the end of the year. Okay, that seems right? That's what a percentage growth is, right? Well, that doesn't take into account when I put the money in. This is the time part. So if I put the money in when the market is actually down 0.2% and it rises up to what is a number? Let me think. 16%. It rises up 16%, right? Well, my growth is actually way larger than the 7%. Would you agree? But if we take those two periods, -2 and then 16, divide that by 2, it gives you, 7, right? 14 divided by 2 is 7. But that's not what's advertised. And so I wanted to break that down as well. And maybe I'll throw some graphics up on the screen and make sure, that there's some visual aspects to this as well, because I think it's important that everyone is consuming this information and not just, hearing it and may not be able to understand. And so that's the second thing, right? So we have fees, we have average versus time, and then we have taxes, right? So in a retirement account, you can take out, that money is taxed. You can take it out, but it's taxed and it's penalties. So when you take money out, let's say you leave it until the tax age of 65. Well, the tax age, the retirement age of 65. You know, under legally you can start with making withdrawals at 59 and a half, but let's just say you leave it for 65 in this example, as that's the example that we've been going with, the number that we've been going with through this whole conversation. So you have the money in there, you withdraw it out at 65. Okay, so now we know that we could have had 576,000, but we only got 174,000, right? 174 or 140, excuse me, 140,000. Okay, so now we withdraw some money. Now that money gets taxed, right? So depending on the tax bracket that this person is in, and I can't really get into all of that just because everybody's situation is different. But what I wanted to say is, depending on the situation, that number, that withdrawal, is going to get taxed. So not only are you missing out on the 576 because of fees, not only are you not being told the true return, because average versus time, because you're not dumping in 100% of your, you're not going to max out your 401k and January 1st. No, you're going to pay over time, every 2 paychecks, or every paycheck, every 2 weeks. Whenever you get paid, money is going to go out into that. So it's going to be over the course of time, which means you'll have different time periods for every installment of money, right? Which comes into an average. So you may put in some money when the stock market is up, and then it comes down. That's going to affect the average from when you put in money when the stock market was down, and then it rolled it up. This is called dollar cost averaging. So you're going to be dollar cost averaging into the market over the course of the year, not dumping all of the money in on the first day of the year. So we have that, we have fees, and then we have taxes that is going to come into play when it's when it's your turn to withdraw this money. Now, when the average person like you and I think of our number for retirement, right? Let's say our lifestyle takes $50,000 to live. Let's keep it whole numbers, whole simple numbers. $50,000 to live. We have $1 million in retirement. How does the traditional method of the working mind and the financial industry tell us that we should use retirement? Well, to me, with these stipulations that we just went over, it's still a matter of two things. It's still a method of two things. You can either withdraw the money from retirement, right, from your retirement account, meaning that you leave the money in there and you withdraw on year one. The end of year one, you withdraw 50,000 from the million, which is 950,000. Or you leave the million in there and withdraw a percentage, right? So there's something called a safe withdrawal rate, and that typically means it's a standardized, summarized percentage that says you can typically withdraw a safe number of 4% on an investment and leave that investment in there and only withdraw the 4%, and your money will continue to make money, right? So for example, we have a lifestyle of 50,000, but we have $1 million. So let's say we have the 4%. And I'm not just making this up just because this is the example. We can even say that our lifestyle is 40% so that it fits, right? So let's go with that. So instead of 50%, we're going to go with 40%. So our lifestyle is 40%, $40,000 a year. It costs $40,000 a year to live. We have $1 million. We can safely withdraw 4% on $1 million annually, right? So we safely withdraw 4% on $1 million annually. What is 4% of $1 million? That's $40,000. I don't have to do the math. You shouldn't have to do the math. But if you do, I'm going to put it right here. Okay. So $1 million times 4% is 40,000. So now we're saying, okay, we have the money that we need to live, which is great, right? This is the traditional method. We have the money that we need to live. Okay. But this doesn't account for the fact that there may be up years, there may be down years in the stock market. So what happens if you need 4%, but the stock market went down 1%, right? The stock market went down 1%. So 1% of 1 million is 990,000. Well, 4% of 990,000 is no longer 40%. What are you going to do? In most cases, you're either going to get a job, which why would you get a job when you just retired and you have money in your 401k? So this doesn't hurt. Let's pull out the additional money to equal 40%. Okay, so now you lost money on the market and you're withdrawing money that you need. You need this money to stay in there to make 4%. Okay, so what happens? The next year, say the market goes down another 5%. Okay. So you do the same thing, oh, I mean, it's 5%, the market's going to bounce back, blah, blah, blah. The market bounced back. Okay, so we make 10% next year, the third year. Where do you think your money is? Where do you think the money is, right? So your $1 million loss, 1%, which is $10,000. So now you're at 990. You're at $990,000, $990,000. You withdraw 40. So you're at 950,000. You should be at 960, but you're at 950 in the account. Then the market loses another 5, I said. So let's do some quick math. 9,500 times 5, which is 10,000 times 5 is $50,000, but minus 2,500. Yeah, minus 2,500. So you're looking at $47,500. So $47,500 that you lost. So now you're at $903, right? $903,500, somewhere around there. But then you have to take out 40,000. So you take out the 40,000. So now you're down about you're down about the 860. But then there's a 10% increase in the stock market. You think you're back to $1 million? Nah, I don't think so. So 10%, move the decimal. So you made about $86,000. Add the $86,000 onto $860,000. You're only back at $940 some odd thousand. And then you pull out another $40,000 to live in year 3. So now you're down 100 grand in 3 years. 3 years you're down 100 grand, and there was a level market, a market that was down 5%, and then a market that doubled. So what they're going to tell you is our average return is 5.5%, right? That's over the 4% mark. But look at where your money is. And if you don't know where I got the 5.5%, that is the -1 plus the -5, which is -6, plus the 10, which is 4 divided by 3, right? Not even. That's not even 5.5%. That is 1 something. And I'm doing this math off the top of my head. I'm not looking at anything. And so we can even add on another year so that we can make the numbers look great, right? So you could say another 20% rally. So the money got to 20%, and where do we leave at off? We left off of 900,000. Okay, so now move the decimal point, boom, boom. Move the decimal point, boom, boom. 900, that's $90,000 doubled, so 180,000. So now you're at 180,000. You're at $1,080,000. You pull out 40, right? You pull out 40. Okay, so you're at $1,040,000 in 4 years. Your money's actually made money for you. You had some scares, but it made money for you in 4 years. You think year 5 you're going to have another big rally like that? You just had 2 big rallies back to back. So you get some drawback, whatever. My point is, do you think it's sustainable? Do you think it's sustainable to pull out 40,000 every year and not need anything else? Do you think it's sustainable for that million to be $1 million year after year after year? My answer is no. It's not sustainable, right? Because even if you got a average 9% and then you lost some years, it's not sustainable. Trust me. And if you want me to comment below, if you want me to actually show you like a 20-year rate of return or a 10-year rate of return versus actual returns, right? We can do that. I'll make a whole episode if you guys want it, and we can go through and see just how sustainable it is. It's not sustainable. And even if it is sustainable, why would you subject yourself to that stress? There got to be another way. Is this the best way? Is this what the wealthy is doing? I don't think so, right? I don't think so. So outside of owning a business, cashing out, outside of having a bunch of income producing real estate, outside of using a pension, which are fading away, and outside of Social Security, what other ways, and outside of hitting a lottery, which is, 1 in a million, what other ways are there to actually retire so that you don't have to worry about market volatility, right? Because both ways we looked at, whether you're just pulling the money out and not worrying about the market every year, or you pull out your safe withdrawal rate and you worry about, the market volatility and different things like that. If that's the case, I personally would still probably get a job just to see if I could balance out the losses, right? If I could hedge against the losses that my 401k is going to take, because I absolutely need that $40,000. And who wants to work another job? I'm a millionaire and I still got to work. Which brings me to my next point. Are you technically a millionaire, right? Technically you're a millionaire, but you can't touch the million or you'll go broke, right? If you take that million out of the market, what are you going to do? Are you sure that you can produce more money for yourself so that you can truly say that you're a millionaire? Or are you going to spend the million and then go broke, right? So that money being in the market has to stay there so that it produces money for you. And this is what they call illiquid. It's liquid technically. It is definitely liquid. You can pull that money out anytime, but it's not at your best benefit and it's not reasonable for you to do that. And most people won't do it. So technically it's illiquid, right? Well, in real life, it's illiquid. And so those are some things that I want to put on a plate and think about. Is this the best way when we talk about a 401k, right? We got to go through the fees. We got to go through the taxes. We got to go through market volatility. Is this the best way for us to retire? And this is what all of us are taught on. You go to work, you put money in a 401k, you save up, then you retire. That's the best way. I'm actually going to end it right here. Let you think about that. Have a conversation. Share this with someone that you know who may be in the same boat or who may, not be in the same boat. Because the end of the day is, like I started this podcast with, 80% of us have this problem where we don't know how we should save for retirement. We don't know if the 401k is going to be enough for us. We don't know what we're investing in, right? And then of the people who do know, 50% aren't confident that they can save enough for retirement. So this is the problem that we don't know that we have. And by the time we figure out that we have a problem, it's often too late for us to solve the issue, right? And so I'm gonna leave it there. This is Finance King. Make sure y'all share this with somebody, have this conversation at the dinner table. If you want to talk to me more, let's talk about it, or tune into the next episode. It's Finance King. I am sitting at a different location with a different angle, partly because my children are asleep, but I wanted to get this out. It's been too long. And yeah, also, I know I said I was going to save this. I don't want to get into my next segment because I want to keep this relatively short, but I will say that the account I started with $200 is now up to $350 in a short span of time that we was at. So, investing is going well. And I'll get into more of that later. But again, I'm signing off. I wanted to keep this brief. This is Finance King. I'll see you on the other side.